Good afternoon, and welcome to the Insurance Asset Risk Asia Forum. Today, we're going to be discussing how to actively manage the changing insurance landscape. And today, we have three esteemed guests to help us discuss this very pressing topic. We have Jajit Kumar, who is the head of Asia Insurance Solutions with Invesco. We have Benjamin Den, who's the Chief Investment Officer with China Pacific Insurance. And we have Yezdi Chinoy. He's the Regional CIO with Generali. Okay, so let's begin. The first question I'd like to ask is to Jajit. So in this year that has been like no other year, the insurance industry has seen a lot of changes. I'd just like to get your thoughts on how is the current market environment changing the insurance industry as we know it.
Great. Thank you, Raymond, and very glad to be part of this panel with distinguished colleagues here. So we've been in this low interest rate environment for some time, not to mention obviously what's happened over the past 12 months. But for insurers, we've also seen introduction of regulatory changes in regulatory regimes, RBC and accounting changes on the way. And so this has created a fairly complex environment for insurers, which we feel requires a more holistic assessment, no quick fixes, no kind of magic asset classes, but rather looking at the portfolio as a whole to see what can be done. Now, 5 to 7 years ago, a lower for longer was really a stress scenario that insurers were looking at. And as the name implies, this was considered a stress scenario. Here we are 7 years later, and lower for longer in terms of rates is pretty much a base case. So what this has done is this has made insurers look a lot more intensely at all sources of return and yield, but also at the same time looking at how to make their portfolios more efficient from a capital consumption perspective. Added to this is kind of how best to structure asset exposures in light of accounting changes and so on, and really how to extract efficiencies from the portfolios. So we're moving away from maybe minimizing capital to maximizing this return on capital approach. So how does one kind of do this? We have a broad spectrum of insurers in the region, some with very well diversified balance sheets, others judiciously looking to add asset classes, others reallocating assets and maybe considering portfolio overlays, not mutually exclusive, of course. And this is what we feel will drive investment activity as far as the insurance asset management side is concerned in the region. This really looking at more of enhancing the investment portfolios as such. One last point to add to this is on the liability side as well. We're seeing insurers kind of diversifying their product risk. So focusing perhaps more on health and protection type products, which of course fits with the demographic trends we're seeing in the region, but also happen to be more capital efficient compared to kind of the traditional high savings product. So this move, both on the asset and liability side of looking at how to enhance portfolios, maximize kind of the use of capital, is a trend we feel will continue in the region for the next few years, at least as long as we're in this environment.
Okay, thank you very much. Now, of course, all eyes at the moment are looking to China in many ways, because China is one of the economies that seems to have bounced back a bit more from some of the global turmoil of the last 12 months. And Benjamin, one of the things I'd like just to hear from you is basically, what do you think are the key capital and risk issues facing insurers in China at the moment?
Well, in China, the insurance industry has been growing really fast in the past years. Every year for CPIC alone, we have like 200 billion renminbi renewed investments and plus the new investments from premium. So that investment pressure on the yield is is mounting. When the in-force investments start to phase out gradually each year. And we've seen last year, rates went down dramatically and took a V-shaped recovery in the second half of the year. So what we face is a tremendous amount of pressure of adding on the duration of the assets to match the liabilities. Bear in mind that China still is, in the insurance industry in China, it is still a very traditional industry. The product mix are very traditional with long-term non-participating products and also participating products. So the requirement for us to lengthen asset duration is very significant. So what we did was at CPIC last year, we basically tripled the investments as compared to the budget on long-term government bonds and quasi-government bonds to lengthen duration. And so the risk in China now is in the capital market is credit risk. Everybody was talking about credit risk. We see that coming. We saw that coming a few years back. So we prepared ourselves very nicely by limiting certain kind of credit risk that we don't want to touch it. And also thanks to the regulator basically says below certain credit ratings, insurance companies cannot participate. So that naturally has sort of ring-fenced our portfolio from certain competitions. Then internally, we built our internal credit risk system for the entire group and implemented very diligent and disciplined processes on credit research. So how to judge, how to assess the credit risk in China is a big challenge today because the country is in the change phase. The transformation from a previously largely state-owned entities, state-owned platforms, which issued a lot of debt, they're gradually transforming into more market-driven, market-oriented, and with more complete risk profile. For the lack of good words, to put it in a more balanced way. So we are facing more credit risk, but in the meantime, it's not like that the government is dumping the credit risk on investors overnight. Things have to be planned and managed gradually, and while taking the economy from a planned economy into a more market-oriented economy. So in this change phase, we have to build our own methodologies and philosophies, which you cannot borrow from past experiences, whether from Moody's or S&P. The world has not seen this, and we have to navigate in between and find our own safe path. So that's the risk in China's capital market. The flip side is the market is deep and wide is getting bigger. And so I think for most of the insurance companies, we are if I compare to foreign or offshore globally insurance companies, I think insurance companies in China are in a better position today. Still, we're getting higher yields on the bonds, government bonds. We are not seeing tremendous amount of credit defaults. While the risk is growing, but the actual default is not as bad as people thought 5 years ago. It's just being gradually growing, and we can plan ourselves better. And the equity market is doing well. Last year, if you take a look at our financial reports, we had a fairly decent investment return for a large portfolio like CPIC's. The total investment return was 5.9%, largely coming from the equity market. It took a V-shaped return. In March, it went to the bottom and then recovered really nicely in the later part of the year. So we took a nice return on the equity portfolio. So I think for whoever comes into China's market, we'll see the attractiveness in the long-term government bond space, and also the equity space that includes both public equities and private equities. Private equity has a great future in China. It's in a change phase, but it's growing, and we see certain sectors that have the potentials are building, and it's very obvious the potentials, like in the medical science, medical equipments, medicines, AI, artificial intelligence. Many things. So yeah, I think it's a really deep ocean in China. We have a lot of opportunities in harvesting return.
Good, excellent.
Thank you.
No problem. Now, of course, obviously, China is a massive market, but Yazdi, I suppose what I'd be curious to hear from you is how does somebody apply a strategy across Asia, given that there are a mix of, say, developing and developed economies, and what are the key things to think about in other parts of Asia?
Sure. Thanks, Raymond. So basically, from a insurance market overview perspective in Asia, you have a very wide spectrum on which you can operate, which meant that you could have a extremely highly developed market like Japan, Korea, Singapore, Hong Kong, where you have multiplicity of products which you can invest in. So on the asset side, you can invest into a lot of products, both conventional, which means fixed income equities, and alternatives, and other products which are essentially structured products, right? And therefore, there is a lot of choice essentially in these markets. On the other hand, you have developing markets and actually what I would call frontier markets, where you have infrastructure issues in terms of even products. So in markets like Vietnam, you would probably end up investing primarily into the fixed income, local fixed income, and that to government bonds, because even the corporate bond, arena is quite limited there.
Mm-hmm.
The other challenge you have in many of these markets, including in Southeast Asia, is I would say a lack of recognized credit rating institutions.
I see.
So yes, you have local credit rating institutions. Some of them have equivalence to the global rating institutions. Some of them have tie-ups, some of them have joint ventures. But when it comes to an rating equivalence, you have limited rating equivalence or limited recognition of rating equivalence in these countries on the credit rating side, right? So essentially, there are all of this. And then, of course, the next one is what we talked about in terms of low for long. As was discussed earlier, it is unimaginable that interest rates have fallen from, let's say, double digit to, in some cases, lower single digit. Markets in Asia have seen falls of between 120 basis points to 150 to 200 basis points in the last 12 to 18 months, which is quite, shocking. And it's obviously as Jayjit mentioned, it used to be part of the worst case scenario discussions, but it's now almost like a base case because you expect volatility in the markets at that, because you've seen it in the last 12 to 18 months. So to that extent, there is this requirement, because you've issued policies a number of years back, right? Some of them guaranteed certain returns, right? And therefore you have to meet those returns come what may, come hell or high weather, so to say. So in that sense of the term, you're still looking for relatively high yielding assets. And yes, you can say that you could have bought those assets 10 years back. But then again, insurance in its simplicity is underpenetrated in Asia. There is a huge amount of room to grow in Asia, especially in the developing countries. And therefore, many of the insurers, bar some of the older ones, have, I would say, what is called very new books. So you have made investments only in the last 5 or 10 years, when interest rates had already started falling. Whereas some of the older insurers could have bought 30-year bonds 30 years ago, which obviously are very valuable today because of the yields that they locked in at that time, right? So those are the multiplicity of factors under which insurance, companies operate. And again, unlike in, let's say, some of the more developed markets, cross-border investments are severely limited, if not prohibited, in many of these insurance markets. So you cannot invest from one country to another country because you have restrictions in terms of local insurance investment requirements. Regulations have been changing. In some cases, they've become more insular from an insurance perspective because everybody's trying to, protect public interest, policyholder expectation and make sure that the money that they have, entrusted to us as insurance companies is protected in a sense. So there are these factors which have essentially influenced decision making in terms of asset allocation, and especially in an environment of low yields. And again, I think let me also clarify that low yield from an Asian perspective, especially in the emerging markets, does mean that yields will go up to a certain extent once they have gone down. It's not going to flatten out as we see especially in Europe, right? Where we are talking about, or even Japan, for example, where yields have been flat to negative in many cases for a very long time. But that's not a scenario that should be discounted at this point of time. And in some of the countries and some of the companies where we actually talk about these quite intensely in terms of looking at it from a 5, 10, 15, because I mean, some of the policies are whole of life. And therefore, you have to think about it from a long-term perspective. Because then you can not only invest in a 30-year bond, but guess what? If you have a 100-year policy, you then run a reinvestment risk, because more or less, like, I mean, none of us have a crystal ball, but it's very likely that in 30 years, you'll have a much lower interest rate than what you have currently. So to that extent, I think it's trying to balance, the concept of low for long with the reality of having to make sure that you have an asset allocation in place for a low for long scenario today, rather than in 30 years or 10 years or whatever it is.
Excellent.
And then just one final point: demographics. So we've actually, so insurance is kind of managing the long-term expectation for the policyholder, including their life, health, and of course, all of the other stuff that goes with it. And I think Asia has been touted, especially in countries like India, China, etc., and Southeast Asia, on the demographic dividend that is essentially the younger population with a of working age who will probably have a number of decades to go before aging. And I think the prime example which we should study is Japan, because Japan has a huge demographic disadvantage now with a very highly aging population, and of course where interest rates have been very low for very long. It's not very far away for some of the other countries in this part of the world, maybe a couple of decades before that demography starts hitting them in a negative sense. And I think that's one of those things from an insurance perspective, which we need to also understand and study and analyze, because so on one hand, insurance is underpenetrated in most parts of Asia. On the other hand, you will have a very rapidly aging population, which with pension plans in many of these countries, which are really you save and you save for your retirement, so to say. You don't really have government support, or you don't have really government. I mean, you do have oversight, but you don't really have support from the government in terms of that. So that's really my final point.
Okay, good. So given, let's say, this overview of the general situation, I'm just wondering if we could kind of discuss a small bit about how this has affected asset allocation as well. How about Jajit, just from your experience, what you've seen various insurers doing, what's the kind of asset allocation mix right now?
Sure, absolutely. Yeah, so I mean, Raymond, as pointed out by both Yesdi and Ben, I mean, insurance has been around for a long time. We've gone from high interest rates down to low interest rates. You have legacy policies. So I think one thing that's really been apparent, and this is not something new, but over the past few years, is this increased focus on private markets. I think insurers are coming to the realization that public markets have served their purpose. And if you really want to continue to maintain yields, returns for which you price policies, or be more competitive, you need to start looking more at private markets. And private markets fit kind of the profile of insurers fairly well for the most part. It's long-term kind of stable returns. Now, what's obviously important is for an insurer to make sure that the risks they're taking by investing in private markets, be it private equity, private credit, infrastructure, real estate, and so on, they have a clear understanding of the risks they're taking, illiquidity risk, for example. And that's something that absolutely needs to fit within their risk appetite. And so then it becomes a matter of going into these different markets and trying to extract that value from them. But at the same time, making sure that from a regulatory risk capital perspective, as these progressively get introduced in the region, you're still not, throwing away capital. You're still trying to maximize your return on capital, making sure all your risks are contained. And I think quite importantly, making sure you have the operational, the accounting, the reporting set up to kind of cater to the illiquid, the less public information nature of such markets. So that's something we've definitely seen a trend. Mm-hmm. Some insurers, of course, are further advanced. They're investing in private assets to a larger extent than others. Others are sort of dipping their toes into the water, so to speak, to kind of get a sense of where they should invest and how best to kind of invest in that market. In addition, what kind of RBC regimes are, again, pushing a lot of insurers to do is to look at kind of any hedging strategies, any systematic overlays that they can put on their portfolio. Again, this is more to, manage their capital requirements and to protect against any stress tests. As Ben also mentioned, you've had periods where equities are fairly volatile. There's a huge dip and there's a swing back. For insurers, this becomes complicated is because they need to be solvent at all times. They cannot wait for equity markets or interest rates to recover. If equity markets and interest rates fall and they're insolvent, that's an issue. So all kind of the asset allocation needs to factor all these considerations. You need to do regular stress tests. But I think the general trend is one of looking more and more at kind of private markets to extract more efficiencies and return.
Very good. And so Benjamin, in terms of the China Pacific, have you noticed a sense of your approach to asset allocation changing much, let's say, in the last year, or is it more of a gradual change, basically?
It's a gradual change, but what we did was it's three segments in our asset allocation whole framework. First one is the strategic asset allocation, which we optimize the portfolio from top down and bottom up. It's a three-dimensional framework. The top down would be using the solvency ratio as the core risk appetite measure, and optimize the entire portfolio based on very long-term assumptions. That's the like more than 10 year and beyond, based on the market reversion, mean reversion, return assumptions, risk assumptions, and correlation assumptions. Then once we optimize that portfolio, we have a tactical room above and below the SAA targets. And then that's the whole total portfolio optimization. Then we have a bottom-up approach for each sub-accounts. That means different life products, say participating product, non-par products, and universal life products. They will sum up to the bigger portfolio, but their own allocation will be different depending on their liability characteristics. And then we have a third dimension, that's a time dimension, which we will take our balance sheet and do a Monte Carlo simulation over 20 years time to see how far down the road we may face the risk that the asset yield will fall below the required return on the liabilities. So that framework gives us the confidence and the anchor of the portfolio that we will stick around for a long time. That's the strategic part. Then we build a tactical part. That's really what's so that because the market and the global situation is very dynamic. So what we do is we have to read into the market dynamics and make a conscious decision and play by the book. That's very important. We play by the disciplines. We don't just go into the market and get out of the market by one shot or by a very subjective decisions. It's really based on deliberation and the conversations that we decide how to take our portfolios into and out of the market. That's the very disciplined tactical part of the allocation. And the third one would be the value investing, the security selection. On that part, CPIC has a long tradition, and it's part of our culture that we want to select the securities that will last longer with a higher margin of safety, then we built our value portfolio. In the past many years, we have outperformed the market by quite a wide margin because of the security selection capabilities we have in our teams. So that's in a nutshell, that's the framework we have. But then what has changed in the past was we used to be much heavier on credit risk. The private financing vehicles for infrastructure financing those. But then starting based on the new regime, the new era has pushed us more toward a barbell structure. We're still heavy on credits, but we are putting more new money into the two ends. One is the long-term government bonds, which will lengthen duration. Bear in mind, in China, there's one particular policy, tax policy, for a profitable business, insurance business. The government bond, the interest income on the government bonds are tax-free. So if the nominal interest rate is, let's say, 3.9% or 4%, after tax rebate or tax exemption, it's more than 5% return. Really, that's a very nice income. But the supply is very limited, of course. Then so we go down heavily on that one. On the other side is the equity market. So I mentioned we do tactical allocation. Strategically, we did lift the allocation benchmark in equity, both in public equity and private equities. And we just a few weeks ago, we have established a new company, a new subsidiary, purely focusing on private equity and real estate investments.
Oh, very interesting.
Yeah, so that will give us the platform to launch a fund of funds, and we're going to focus on first. Fund of fund will be very much focused on healthcare, health insurance, medical industry in those investments, and then we're going to have a second fund, possibly more related to carbon neutral ESG themes. So we're planning facing the launch of our funds in the next couple of years, and then real estate. We're going to have it's not so much because of the pandemic. We're seeing really diverging real estate market in the commercial real estate. Some parts will just be the vacancy rate has gone up and may not return in the very near term, or could stay highly vacant for a long time. But the gateway cities like in Shanghai, Beijing, and Shenzhen will still have high demand. And plus, we're seeing the IDC, the data centers. We're seeing logistics. Those real estates are booming, and also real estate related to ESG will have a great potential. So we're putting a bit more focus on those part of the real estate sectors. So in terms of asset allocation, these are the sort of differences, if I can compare to the past years.
Okay, very good.
Yeah.
And Yezdi, in terms of how, say, you're thinking of asset allocation, especially across Asia, I thought you said something very kind of interesting there about how, say, Japan is a very mature market. I'm just wondering how you approach, as you mentioned, let's say some other markets where there may not be as much information, and how that might affect your kind of asset allocation mix as well.
Yes, indeed. So as I mentioned earlier, there are infrastructure challenges in certain markets. And by infrastructure, I mean capital market infrastructure challenges. So therefore, in certain markets which are still developing, including in Southeast Asia, or markets where you could potentially launch, or you could have a investment into, let's say, assets which are, I would say, non-conventional. That's still being worked on in many senses and in many cases by the local governments, and I think, or the local authorities. But I think one of the things that is going to be interesting coming out of the pandemic is the fact that because of the regulatory changes, a lot of regulators are, coming to a conclusion that they need to open up some of their markets much more than they had in the first place. And it just doesn't mean foreign flows, because I mean, foreign flows, as we've experienced over time, tend to be what we call hot money. They flow in when it's attractive and flow out when it is not. And regulators and governments are pretty much concerned about those kind of flows. They would rather have FDIs than FIIs, so to say, or whatever you call them in many of those countries. But from an insurance perspective, I think, and I think Ben was talking about strategic asset allocation, tactical asset allocation, and allocation of assets across various asset classes. And I think that's pretty much how we run the portfolios as well. The only thing that will change, and that has changed over time, is the fact that we were heavily skewed towards fixed income investments historically, right? Our portfolios were overweighted on fixed income. Again, conventional fixed income. So you had government bonds, you had corporate bonds, all of that stuff. I think over time, we will actually slowly shift out to, let's say, alternative asset classes, because conceptually you have the in-force portfolio, where you have to make sure that you are meeting the requirements for the policyholders who have already invested into you. And then you have this, the new business, which is going to come in terms of new products and in terms of new business to existing products, right? So again, because of the changes in regulation, changes in the operating environment and capital markets, et cetera, you've had a move from many of the insurance companies to launch products or to structure products which are more capital light, as it was, right? Which consume less capital. And Asia has been through some of these experiments earlier in terms of investment linked, right? In many countries, we've had or we have investment linked products. Unfortunately, what happens with investment linked products is essentially the behavior of the policyholder. It mirrors pretty much the market. So when the markets are doing well, especially equities, you will have a lot of flows into this. Of course, you also have reverse flows when markets are doing well, because people want to exit at a profit. And then, of course, because it's an advisor-driven market or an agent-driven market, you'll also have some of these people with their own agendas in terms of trying to say, okay, get out of equities, get into, let's say, stocks. So, I mean, over the last 1 year, based on the information I have, many of the markets in Asia have had huge participation of retail investors into, let's say, equity markets, because equity markets have been booming, right? So you have to actually study and understand the pulse of each market to be able to figure out what investments into what asset classes to make there. But again, going back to the low for long, and the fact that we have to meet policyholder expectations, and we have to essentially meet illustrations which we are making to the policyholders over the longer term. I think the asset allocation shift is already underway. And you will have more and more, alternative assets being invested into. The only challenge is, and in some countries you have, for example, whether it's private equity, infrastructure debt, all of that stuff, is first of all, there is no consistency of nomenclature in terms of how it's evaluated, how the investments are made. Secondly, valuations tend to be frothy at times where, those markets are doing extremely well. You have challenges with valuations, and sometimes, unless you have a deep knowledge of a particular industry or a sector or even the company, it's going to be challenging to invest from the outside, let's say. So you have to have local knowledge and understanding of what you're investing into. And then, of course, as I mentioned earlier, ratings tend to be challenging. Because again, there is no equivalence which you can, or there is no studied equivalence where you can say a triple A in China or India is equivalent to a triple A in the US or Europe. So that's something which will need to kind of be looked at over time. And I mean, these are public markets. In a private market environment, it's going to be even more challenging unless you have your own ratings team to be able to do the bottom-up assessment and have access to management to be able to understand how it's going to work.
Very good. Well, then, as in, these are some of the challenges that we've discussed, and we've looked at the kind of overall environment. What I'd like to maybe finish off on today is talking about some solutions to these issues. So, Jayjeet, I'm just wondering, as in, given the things that we've seen and some of the points that we've heard today, Benjamin talked about how this kind of credit risk in China, while it's been talked about, it hasn't maybe been seen in reality. And Yezdi has talked about maybe the information gap in some emerging markets, some of the kind of product gap in some of these emerging markets. I wonder if you could share with us, I don't know, some of the kind of new solutions that you've seen come on board. And then we'll talk to kind of Yezdi and Benjamin about which of these solutions they seem to kind of like the best, basically.
Sure. Yeah. So, as mentioned, so for most of the region, the angle that most insurers are now looking at is kind of this return versus risk trade-off. So how to maximize one and minimize the other. So within this, obviously, there's a wide spectrum. You do have kind of private markets which offer potentially higher expected returns, but they come with a higher capital charge in most cases, obviously. And so the aim then becomes, how do you still access these markets, trying to minimize or mitigate sort of the impact of that capital charge. So then it becomes a very granular approach. You look at kind of the solvency regimes. You look at what capital charges for the various sub-asset classes, and then try to design a portfolio. So SAA, try to incorporate some of that, some of those elements in it. You might find that if you, let's say, hypothetically shorten duration on lower rated credit, that gives you a better bang for the buck. If it was so short duration high yield, for example, might turn out to be more efficient than your typical long dated high yield portfolio. So it's really going in and looking at where you can extract those efficiencies. I think to the point that was made, private markets obviously by their nature are private, and therefore information is lacking. And so what's important is to ensure that if you do go into these markets, you have a thorough understanding of on the ground realities, as it were, but also how you bring that back within your kind of portfolio construction process. So looking at all aspects of risk, liquidity, complexity risk, which is another source of premium, and whether that's something you're happy to take. So for us, in discussions with clients, it's, again, there's no turnkey solution as such. It's kind of looking at the whole portfolio construct and to look at where efficiencies can be extracted or what asset classes sort of make sense, and indeed how to take how to take exposure sort of in a capital efficient way. This could be through some sort of structured note product, which links to kind of a basket of private equity. A lot of this obviously depends on the regulations in each country, so we need to make sure that we're within the regulations, and importantly, any accounting considerations are taken care of. The last point is, again, where permitted, derivative overlay, so portfolio, so extend duration using swaps or putting in some sort of equity hedging solution to mitigate the high charge of naked equity is some of the other aspects we're discussing. So again, as mentioned, it's very country jurisdiction specific, it's very product specific, and so the intention is really to look at all these in a whole to kind of come up with solutions that work for our clients.
Thank you very much. And briefly, Benjamin and Yezdi, just to conclude, if there was one solution that you think insurers would be wise to be looking at over the next 12 months, what do you think it is?
You want to start with me?
Yes.
Thank you. The one thing that I'm particularly interested in is taking access to foreign markets, but then hedged back to renminbi. I was in charge of derivative strategies for AIA for a long time, and I've been looking very closely on the currency hedging market. If you look at the cross-currency swap between dollar and renminbi, there is a very nice yield pickup because of the yield differentials in two countries and also the basis swap dynamics. So if I lock in a 3-year cross-currency swap, I will get a 2.5% yield pickup from dollar to renminbi. So to put it in a simple case, if I can invest in a fixed income asset in the US or Europe, and that yields, let's say 3% or higher, let's say 4%, then I add another 2.5% on top with the cross-currency swap, I'm getting a very attractive investment yield in renminbi terms.
Mm-hmm.
And we've been working with some asset managers, global asset managers on that, and I'm interested in further exploring that this channel, so we can broaden our investment scope, tapping into global markets without taking the foreign currency risk, but also enhance our yield.
Excellent.
So that's one particular investment idea I'm very keen on.
Okay.
Other things like dollar-denominated direct investment opportunities, like in the private equity funds, those are something we regularly explore, and I'm going to expand our scope in investing in those targets. Yeah.
Okay.
Yeah. Thank you.
Good. And Yezdi, if there was a young insurer coming into the market today, and you had one piece of advice for him to pay attention to something, what would that be?
I think it depends on where that person is coming into the market, which country, right? Because you have a very broad spectrum, and Ben was talking about cross-currency swaps and derivatives. In certain markets, you actually have only one or two derivative products which you can invest into, right? And that makes it quite challenging even to undertake a derivative transaction in that particular market. And so it depends on the market. So I'm not going to talk about the advanced markets because they have a lot of flexibility and ability to allocate into different asset classes. But in some of the more developing markets or the less developed markets, you would have to have a wider product range to be able to invest in. And I'll give you an example here. Let's not talk about government bonds or corporate bonds because most countries will have that. But for example, there is a discussion on covered bonds, which is taking place in many jurisdictions. But some of the more or the less developed countries don't have that kind of concept of, let's say, issuance of covered bonds, right? So I think the market needs to evolve to be able to, let's say, sell those products, and therefore the insurers would subscribe to those products. And of course, alternatives is attractive in any of these developing markets because we've seen private equity, private credit, and in some cases now, if you ask me, even distressed is going to probably come to the forefront because of all of the situations that we are seeing evolving in these markets. So you will have either infrastructure or distressed credit or distressed debt being kind of discussed in the near future.
Excellent. Well, that has been a most interesting discussion. I'd like to thank our panelists again for sharing their insight and knowledge with our audience today. So thank you very much.
Thank you.
Thanks.
Thank you. Bye-bye.
Thanks. Bye.
Bye.